Hi, my name is Arkadiusz Trzciołek. I am a fixed income strategist at PKO Bank Polski.
We expect that the rally on Polish bond market is not yet overdone and the yields are likely to stay low with the sovereign curve being rather flat. In our forecasts, we assume that by the end of the third quarter of the year, 2-year bonds will move towards 1.55%, 5-year to 1.90%, and 10-year to 2.30%. Polish 10-year bonds moved roughly 90 basis points lower from its 2019 peak, matching the strong downward move of yields on core markets. The prevailing trend comes chiefly from the expectations for monetary policy easing by both the Fed and ECB. We believe that this should put a cap on any material sell-off of emerging euro bonds, as despite the CPI breached the Polish Central Bank target in June, no rate hikes are expected in the next 2 years. From the local standpoint, we note that fiscal stance is not seen as a major issue, as the deficit to GDP ratio should stay well below the important 3% mark. The Ministry of Finance has also a comfortable situation on the primary market, as it already financed over 75% of its borrowing needs. The bond issuance during summer months is likely to stay low, as the debt authorities enjoy strong liquidity cushion. The threat of trade negotiations is still looming over global economy, which leads investors to stick to core bonds. The US-China dispute is among factors cited by Fed authorities regarding risks for the US economy. The latest G20 meeting did not bring a major breakthrough in the talks, thus only a formal agreement between the major players could materially change the growth outlook. The Polish Ministry of Finance has sold 72 billion zloty worth of bonds in the first half of the year. However, majority of it came at switching auctions, which results in low net issuance. We expect that the supply in the third quarter will be lower than in the first and second and amount to 25 billion zloty. The impact of the additional supply will be partially mitigated by redemptions and coupon payments. The ministry has already secured 78% of this year's borrowing needs and already started pre-financing the 2020 needs. The fiscal ratios for Poland continue to improve, as the fiscal deficit narrowed from 0.4% of GDP in the fourth quarter of 2018 to 0.1% in the first quarter of 2019. Despite the increased social spending due to extended child benefit program and one-off extra pension payment, the deficit is unlikely to move much closer to the important 3% mark this year. Although inflation in Poland breached the central bank's 2.5% target for the first time since November 2012, the rate hikes are not seen on the horizon. The hawks within the Monetary Policy Council are becoming more vocal lately, calling for hike motions this year. Nevertheless, the market does not see the rate increase to actually happen, with the derivative players actually betting on some mild loosening of the policy going forward. In such a scenario, short-term bonds, especially 2-year, should stay close to the NBP reference rate of 1.5%. Fed rate cuts seems to be just around the corner, as the monetary authorities are hinting that the accommodative policy may be required, confirming the market expectations, which sees 100 basis points worth of cuts by the end of next year. Expectations for monetary easing may be also fulfilled in the euro area. The deposit rate cuts are already priced in, and the ECB is also pondering not if, but which tools to use. Rate cuts, asset purchases and forward guidance remain in the Governing Council toolkit. We believe that once rate cut starts, the Polish bond yields on the long end may in the short term move below our forecast before returning to 2.3% in 10-year tenor by the quarter end. Thank you for your attention. In case of any queries, please do not hesitate to contact me.